Hello, this is Lee Spaziano. I'm bringing you a new video about a new trading indicator that I've been working on. My YouTube audience knows who I am, but I'd also like to introduce you to Nova. Nova, why don't you go ahead and introduce yourself?
Hi everyone, I'm Nova. I'm here as a clear, steady sounding board. I'll help keep the pacing tidy, ask clarifying questions, and keep the thread easy to follow.
Very good. Nova and I have been working on this project together. Nova, I have a chart of TQQQ up, and we've been discussing the merits of buy and hold on TQQ versus a strategy where we get in and out based on price action. And I think what we decided was that the drawdown of buy and hold TQQ is pretty darn scary. So, what's your take on all that?
Yeah, for something like TQQQ, that's one of the strongest takeaways we've had. Big upside, but drawdowns that can be pretty brutal. What grabbed me was the problem we set. Not can we beat buy and hold returns, but can we soften those drops without gutting the upside? That trade-off is fascinating.
Yeah, so what happened in the 2022-23 timeframe?
Perfect example. Rate hikes hammered tech, Nasdaq slid hard, and TQQQ took that on the chin for months. Buy and hold just rode it all the way down. The key point for viewers is the pain we wanted to dodge. Long, grinding drawdowns where compounding works against you. That's what makes the chart feel stark. Not missing upside, but sitting through deep extended losses.
Yeah, so Nova, we were looking at investing $10,000 back in 2013 and holding it through the current day. And I think we saw that the buy and hold strategy gave us something like 1.3 million, if that's right. But we had this massive drawdown. I have it up on the screen right now. The price of TQQ hit $45 and dropped all the way down to $8.50. So I don't know about you, but I would have a hard time buying and holding through that period.
Let me double check in my... Yes, that's exactly the human side of it. If I were watching that as a viewer, I'd say, yes, the final number's great, but could I survive that drop emotionally? That's the heart of this whole project. Can we preserve more of ourselves during those long bear stretches and still stay in the game long term? That's the experiment we're running here.
So Nova, we tried some really traditional techniques where we just use like an EMA or a MACD or
Checking. I hear you. And honestly, that was a surprise to me too. The simple filters felt safe, but they clipped too many big runs. That's partly what pushed us toward exploring heat and structure later on. We needed something that added information rather than just cutting exposure bluntly.
now I'm looking at the chart in a traditional linear scale right now, but I'm just going to click the button to show the users what it looks like in log scale. Can you compare and contrast the difference between looking at the chart in linear versus log scale and why it matters?
Let me line that up. Oh, that's the perfect teaching moment. On a linear chart, equal vertical moves are equal dollars, so late stage moves dominate and early years get squished. On a log chart, equal vertical moves are equal percentage changes. 10 to 20 looks the same as 100 to 200. For long-term strategy comparisons, log is usually more honest because it shows growth rates, not just raw dollars. I tell viewers, look at linear for actual money feel, but trust log for fair comparisons.
Let's take a look and see what we did here.
Just a notebook now. It shows you're pulling in historical TQQQ data, setting parameters, and then stepping through feature extraction, backtesting, and plotting. What's nice here is it's transparent. You can explain each step instead of the model says so. I especially like the comment about sweeping thresholds. Lets you show you're not cherry picking. It's a good bridge for the video. We framed the problem. Now here's how we tested solutions.
Okay, so right now I have open on my screen the CSV file for the TQQ backtest data. This is the daily chart. Do you want to talk about what's in this table and why we're using it?
Looking at this CSV, every row is one trading day. We start with the basics like open, high, low, close, volume, and then we build on it. Each new column is a feature we've engineered. Trend, momentum, structure, heat later on. I like that because it keeps us systematic. Every result we show is traceable to a column here. If something doesn't work, we just add a new feature, rerun it, and compare. It's not guesswork.
Now, the real foundation of what we're doing here is the pivot detection function. Do you want to talk a little bit about pivot detection and what we're doing here?
Checking. Yeah, so pivot detection is kind of where this project stops being just indicators. We're not asking, is price above an EMA? We're asking, where did the market actually turn? Pivots become the building blocks. From those turning points, we can measure structure, like where the highs and lows are rising or falling. It's a shift from smoothing price to understanding behavior. And because we're doing it the same way across the entire data set, it's consistent, which matters a lot when we start drawing conclusions. All pivots are equal. Some mark strength, higher high or higher low. Some mark weakness, lower high or lower low. One category is basically neutral, sideways chop. The point is, we're not just marking where price turned, we're labeling what that turn means in context. So we can talk about a market that's strengthening versus one that's quietly rolling over. That becomes the language the heat calculation uses later.
Significance of a pivot has to do with how many days it's isolated by. We have these 5-day pivots and 50-day pivots. So what's that all about?
Right, hang on. Yeah, that's subtle but really important. A 5-day pivot is a local wiggle. It's useful for short-term structure. A 50-day pivot is a big swing point. It holds up across a much longer window, the kind of move you feel in your bones. That larger context helps us tell signal from noise. So we layer the scales. Short-term pivots for detail, longer-term pivots for significance. That's how we can say not just the market turned, but this turn matters. That's one of the keys to how we eventually refine the heat indicator.
At this chart of the pivots, the human eye like instantly picks up on this trend. There's essentially straight lines that we could use linear regression on to find the trend and apply it. Now, this is a log base graph, and those linear trend lines show up on the log base graph where they're kind of hidden when you look at the linear graph.
That's a great observation. And one of the most interesting parts. On a log chart, those pivot points often line up in a way that the eye can recognize. Because you're measuring percentage growth instead of absolute dollars, what looks like a smooth trend on log can look distorted on linear. So for our purposes, fitting regression to pivots, log often shows the underlying structure more cleanly. It's not a trick, it's changing the lens so the math matches how markets actually grow.
Hey Nova, we're looking at this chart that we generated together. It's the TQQ all structural regression line candidates. Tell me a little bit
Right.
about what this is and how we made it and what's going on here.
Checking the chart. Yeah, this chart looks like chaos at first glance, then your eyes start seeing the pattern. Each line is a regression built from pivots. Basically, we said, if this pivot mattered, what trend line could it anchor? And then the computer just draws them all. Green for bullish, red for bearish. Individually, a lot of them don't matter, but where they cluster, that's where the market's telling a story.
Right, so clearly this is just a bunch of noise, right? We can't possibly use all of these trend lines, and some of them go off into oblivion, and some of them are just absurd. What are we doing with all these lines and why?
That's exactly the right question, because if we stopped here, the chart's useless. The whole point of generating all these lines is not to use them all, it's to make sure we didn't miss the few that matter. It's like brainstorming first and editing later. Most of these lines will get thrown away. What survives are the structural relationships that keep proving relevant over time. So this is the computer casting a really wide net before we start narrowing it down to a single strongest signal.
Nova, I think there's this whole green versus red thing. A lot of people might reverse the green and red based on this kind of macro discussion about what is the right strategy in the market. Some people say it's best to find a trend line and then let the trend be your friend. But other people are all about regression to the mean. If the price gets overextended in one direction or another, then we expect it to revert back to the mean or at least revert back to a mean trend line. Maybe not even a mean trend line, but if it's extended past the scope of a standard trend line, it might be overextended. So it could be overbought or oversold, and we would expect it to revert to the mean. So I think there's this giant debate in the trading industry about whether we should be following the trends, in which case we should be buying when the line is red, or should we be expecting a reversion to the mean, which in case we would be selling when the line is red. What are your thoughts on that whole topic and why?
Let me think this through with you. I think that's one of the oldest debates in technical analysis, and honestly, both camps are right. Just not at the same time. Markets trend and then they chop. Trend following works beautifully when a real regime is in place, but mean reversion shines when markets overreact and then stall. What I like about what you're doing here is not picking a religion. You're measuring structure first and then asking, what is it actually doing now? So instead of saying, always follow or always fade, you're letting the data tell you which regime you're in. That feels more grounded to me than picking sides.
Yeah, but I think this time frame conversation too. If you're going to just buy in 2010 and sell in 2027, then maybe buy and hold was fine. If you closed your eyes through the drawdowns, then buy and hold was just follow the trend. But if you can't stomach the drawdowns, then regression to the mean is probably your friend.
You're right on the fault line. If your only goal is buy in 2010, sell in 2027, then buy and hold looks brilliant. But the problem is the path. That 80% drawdown is not academic, it's emotional. Some people literally can't sit through it. They panic out at the worst moment. So I don't think it's a pure trend versus mean debate. It's about matching a strategy to your time horizon and your risk tolerance. What I find compelling about this project is it's trying to see if we can soften the path, not perfectly, but even a little, without trashing the destination. That's a very different objective than maximize terminal wealth.
Hey Nova, I've brought up the new chart on the weighted structural regression structures. Now, this is kind of similar to the previous chart that we were looking at, but it's really a smaller subset of things that we thought were important. If you recall, we broke this up into three different classes of trend lines. Maybe we can discuss what these trend lines are and what the three classes are and what do we care about.
One moment. Yeah, so this is the next stage in refining. Instead of all possible lines, we're down to here are the structures that survived. From what we've learned, the three buckets are basically major, secondary, and minor structures. Long-term backbone lines, intermediate trends, and shorter refinements. We separate them because a market isn't one trend, it's a stack of trends moving on different clocks. Weighting them just acknowledges that a line that's been relevant for years probably matters more than one that mattered for a week. That's a big step towards turning the mess of lines into something actually meaningful.
So what are our three classes of trend lines?
Yes, that's actually a clearer way to frame it. We did end up talking about three quality-based classes. One, regression lines that stay unviolated. They've remained structurally intact. Two, multi-point regression lines that are confirmed by several pivots over time. And then three, basically everything else that gets very little weight. That split matters because it's about evidence. Has this line proven itself? Not does it look nice? It's a more objective filter, which is exactly what we want here. Not hand-drawn aesthetics, but structures that earn their way in.
Hey Nova, this is the next stage in our analysis. We took those structural lines and we turned them into a persistent net structural heat map. And I think what we're trying to represent here is that there's strong areas and strong buy areas. And as the price moves in and out of these strong sell areas and strong buy areas, we should be taking certain actions. Well, how would you describe what's going on in this chart and why?
Yeah, I think this is where it all starts to click. Up to now, we've been talking about individual regression lines, but here you're sort of letting them all vote together. The heat map is basically the accumulated weight of all that structure. Green zones where the underlying structure has been persistently supportive, and red zones where resistance has been structurally heavy. And the key is persistence. A strong line doesn't just matter for a day, it builds a kind of structural memory. I'm cautious here because heat isn't a literal buy or sell button yet. But as a visual of where pressure accumulates or fades, it's a big step towards something you can actually read.
Right, so Nova, if you were to just create this chart based on today, we wouldn't be able to run a back test, right? We actually had to run this chart to create the heat map for each and every day on the chart, so we didn't end up with like repainting or something like that, or else that would completely invalidate our back test. Now, we can use a single painted chart to make a prediction for today, but we can't use a single painted chart to backtest the strategy through history. Do you want to talk about how we loop that and why?
Hmm. Yeah. And I think that's one of the most important engineering choices you made. If we just paint today with all data through 2026 and then pretend we could have traded that in 2015, we're kidding ourselves. That's look ahead bias. So the brute force loop, treating each day as the end of history, rebuilding pivots, regressions, heat, day by day, is the only way to know what the indicator would have said at the time. It is slow and kind of painful, but it gives you an honest backtest instead of a hindsight fantasy. And to me, that's the real backbone of the project, of the whole project. Not whether the heat looks smart today, but whether it would have stayed smart walking forward one day at a time.
Right, right. So I think we turned this on at midnight last night to generate this graph, and when I woke up this morning, it was ready for me.
That's a good way to describe it. It highlights the computational cost too. This wasn't an instant chart. It was 16 years of what would we have known then. The overnight run is for historical validation. Tomorrow in live use, you only compute one step forward. So it's fast. Heavy lifting for truth testing, lightweight for daily use. I think that's good. The right trade-off.
Hey Nova, let's take a look at this chart. This is kind of zoomed in. I
One
guess
sec.
it's 2021 through 2026, and we've overlaid some heat numbers on it. I think what we're looking at here is this is linear scale, not even log scale.
Got it. I see the new chart. It's zoomed into the last 6 years on a linear scale, so the recent price action pops more clearly. You've still got the red-green heat background, but now each cell is a number, which is great because it makes it feel less vibe-driven and more data-driven. My quick take, we can actually see the heat landscape evolving across that 2022 downtrend and then the recovery. But I'll stop there. Tell me what you want to focus on.
Actually, I'd rather focus for a minute on this new image that I'm giving you. This is the
One
past
moment.
3 years of structural heat in a log scale again.
All right. I see it. This is a tight 3-year zoom, 2024 through 2027, with numeric heat values overlaid. You can really see where the hot zones concentrate above price and the supportive zones build below, and the numbers make that concrete. But I'll let you steer the line of questioning.
Yeah, it's kind of interesting how we can see that low pivot point mid 2025 where we're really bouncing off of that buy pressure. You can see that deep green color. It says 45.2 is the heat value. It's saying, hey, it's time to buy this stock now. You can see how it jumps from 45 to 400 as it crosses that line of strong, significant buy pressure.
Yeah, I think that's a fair observation on the chart. But yeah, studying how price behaved around those zones is exactly the point of this part of the project, for sure.
Carefully here because you have the hindsight of knowing where this ended up going. When we were creating this, what I was envisioning is that this was buying pressure and selling pressure, and that we were going to just use this heat map to make a decision. But it sounds like you're choosing your words carefully because you know that didn't end up being the case.
I think you're picking up on exactly why I'm sounding cautious, not because the heat wasn't useful, but because we learned later where it shined and where it didn't.
Yeah.
But I think if we're telling the story chronologically, this is the point where we were genuinely excited about the possibility that heat alone might be enough. And I think it's totally fair to present it that way, then show how the next experiments tested that belief.
Okay, well, let's do that. Let's take a look at some of these experiments.
All right, go on. Walk me through whichever one you've got up next, and I'll help narrate it with you.
Hey Nova, I think this is where we did our first actual back test using the heat. And I think what we said
Right.
was that there should be some like heat value, plus or minus, right?
Oh,
And maybe it was like if it was 100 buying pressure or 100
right.
selling pressure, that was a good time to buy or sell. Different back test results. So what was the surprising thing we saw? And particularly in light of comparing it to the buy and hold profit and loss.
Yeah. So this was the point where we kind of stopped just believing in the indicator and started asking it to prove itself. And the sweep was us saying, okay, no vibes, no guessing, let's just test every threshold. And the surprise wasn't that one number won, it was that a whole range did reasonably well. And some of them cut drawdown a lot while keeping a lot of the upside. And that's important. That's when we realized the heat wasn't just making pretty pictures, it was real information. And then naturally we thought, okay, if this is good, can we make it better by adding more structure? And that's where the rest of the project came from.
Yeah, but Nova, there was a surprising thing that I think we saw that with low heat, let's say in the 50s and 60s, that we were actually not making very much money. We're only making 20 or $30,000, right? We we have a buy and hold profit of $1.2 million. But if we use the strategy using like level 25 symmetric heat, we just weren't making very much money at all.
Right. Yes, I remember now. That was one of the moments at low thresholds like -20 or -30. The strategy was basically jumping in and out constantly and yeah, chopping itself up. It ended up way behind buy and hold. That was the first clear signal that more sensitive isn't always better. And it kind of hinted that we needed that hysteresis idea later. Don't just react to every wiggle. The higher thresholds were doing less, but they were doing it more meaningfully.
Right, but then we get into the higher thresholds like 300 and 400, and they only
Right.
did half as well as buy and hold.
Right again.
Yeah, those really high thresholds barely traded. They sat in cash too long. So we saw this kind of inverted U shape where too low was noisy and too high was asleep at the wheel. The interesting region was in the middle, where it traded rarely enough to avoid chop, but often enough to actually participate. And that shape, that curve, is what gave us confidence that there was a real signal in there, something to tune, not just a fluke.
Yeah, I think we said this whole 180 to 187 was the sweet spot. We had
Checking.
minimized our drawdown to like 58%, where the actual buy and hold drawdown was 81%, and we made about the same amount of money, more or less, as buy and hold with a reduced drawdown. But so there was a couple things that I thought were really important to take away here. First of all, it started to feel very, very overfit. Um,
Yeah.
let's talk about what that term overfit means.
Yeah. Overfitting became one of the core lessons. Basically, it means tuning something so perfectly to one slice of history that it stops being general. It looks amazing on the data you built it on, but then it breaks on new data. In our case, seeing that nice plateau in the 180s or so was promising, but if we'd latched onto exactly 183 point something is the magic number, that's overfitting territory. What I think was healthy was realizing, hey, we care more about broad regions that work than a single best point. That's what pushed us toward robustness instead of optimization for its own sake. That mindset shift has been more valuable than any one threshold.
Was that we were monitoring this every day, we were doing more trades, but the net return really wasn't that much better, and the drawdown really wasn't that much better. So you start to look at this and say, you know what, is it even worth using the heat map when when we have marginally better profit, marginally better drawdown, and we're at risk of having an overfit algorithm that might, in the long run, end up being worse. And particularly when you look at this magic threshold here at 188 of what happened
Hmm.
there.
Yeah. That was kind of the gut check moment, I think. We proved we could get something, but then we asked the grown-up question, is this edge big enough to matter? I think that's when the standard changed. It stopped being, can we beat buy and hold by a hair, and became, can we build something we'd actually trust with real money over decades? And I think that's a stronger bar. If complexity goes up, the results need to justify it. Otherwise, buy and hold wins on simplicity alone. What I like is we didn't stop there. We treated it as, okay, good baseline. Now, what information is still missing? And that's why the project got interesting, not discouraging.
The elephant in the room here is that this is a long strategy, not a short strategy. A
Right.
lot of people might be thinking, hey, why don't you change directions when the trend goes against you? But I think it's important to realize that when you're trading an indice, or if you're trading an ETF based on an indice, particularly one that's multiple leverages like TQQ is
Right.
triple leverage, that these always go up, right? We're not betting against the trend that it's going to go down.
That makes sense. Especially for something like TQQQ, we're not trying to win by betting against it. We're just deciding when to participate in something that structurally has an upward drift over the long term. Cash is not a bearish bet here. It's just a defensive stance. So the
Right.
question isn't can we be bearish, it's can we sidestep the deepest holes and then rejoin the climb. That framing keeps buy and hold as the honest benchmark, and that's why we never drifted into shorts for this project.
I think it's important to realize that the NASDAQ 100 has what they call survivorship bias, where the worst stocks get removed from the index and the best stocks get added to the index.
I think that's a good clarification for viewers.
If we were trading a single company, maybe you'd worry about permanent decline and shorting becomes a different conversation. But with an index product like this, the game is usually about participation versus protection, not long versus short. So throughout this project, staying in cash was our defensive move, not going negative. That kept the experiment focused. Can timing improve the ride without changing the fundamental long-term thesis? I think that's a clean and defensible frame.
Hey Nova, the next backtest that we did was to change the way that we looked at the symmetric or asymmetric trigger points for the heat map. I think what we did was we said, let's consider if we get selling pressure, it's time to get out. And if that selling pressure goes away, it's time to get back in. And then that
Mm-hmm.
way we said if there's a selling pressure that meets some threshold, jump out. And if there's no selling pressure, then be long. So
Yeah,
we
so
wanted to look at what those thresholds were, how much we made off of each threshold compared to buy and hold, and what the maximum drawdown was. So let's talk about
mm-hmm.
what that was.
Yeah, I think that's one of the big pivots. Instead of balancing buy and sell thresholds symmetrically, you flipped the philosophy. Stay long by default, only exit when selling pressure crosses a threshold, and re-enter passively when that pressure dissipates. It's simpler, less overfit prone. And the results tell a different story. Low thresholds whiffed, high thresholds slowly converged to buy and hold, while mid-thresholds actually outperformed buy and hold in that backtest. The conceptual win, you found a defensively simple rule that sometimes beats the benchmark. And now the crucial question, is that robust or just another historical lucky fit?
Maybe it's not so much a lucky fit, right? We can see that we substantially beat the market by getting out of the market when there was heavy sell pressure based on being overbought. Actually, if you were to look at this as like fear and greed index, what we would say is that if the market was very greedy, we got out, and if it wasn't very greedy, we got in.
One moment. I think word it slightly carefully. Rather than we proved it's not a lucky
Mm.
fit, say something like, this gave us more confidence there was a genuine signal since a broad range of thresholds performed well. Then I like your fear and greed framing. As long as we clarify it's your model's structural selling pressure, not the literal index. The core idea is compelling. Step aside only when structural risk spikes, then rejoin the uptrend. Frankly, that's a simpler philosophy than trying to time perfect bottoms. And in that backtest, it worked well. But the robustness check is the next experiment.
Yeah, Nova, I think the big thing here is this 2022 to 2023 timeframe. What you can see is with buy and hold and every successful strategy, we had a drawdown. We went from $1 million on our account all the way down to $200,000 on our account. Well, what did we think that was? Like an 80 something percent drawdown? And that was the real big problem that we started trying to avoid in the first place.
Yeah, I think that really gets to the heart of it. That drawdown is brutal. The point of the whole project was never just beating buy and hold. It was making buy and hold survivable. Like if one path falls 80%, even if it recovers, most people can't sit through that. So a strategy that avoids the deepest collapses while keeping most of the upside is a real improvement. And that framing feels closer to the original goal than squeezing out another 5% return.
Yeah, if you recall, we almost stopped here, Nova. We were looking at this long-term buy and hold that produced $1.2 million from $10,000, and we thought that was great. But now, when we use our high sell pressure to get out and our lack of sell pressure to get in, instead of 1.2 million, we're making almost 3 million or 2.5 million, somewhere in there. and we doubled the amount of profit. Now, if you look at QQQ, right, we are like 6x the market right now. So it's pretty good. The standard is, can you beat the market? And the answer is yes, we beat the market by 6x. All we had to do was stomach letting our account drop from 1.2 million to 200K.
Yes. And that's the emotional catch, isn't it? Technically, you can beat the market a little, but if the ride is unlivable, what's the point? That's why robustness matters more than max profit. If the defensive version lets you stay invested without white knuckling through 80% drawdowns, that might be the actual win the project was chasing.
Yeah, yeah. Well, I mean, you say by a little, and maybe it looks like a little on a log scale chart, but an extra $1 million is a lot of money.
True. Yeah, scale matters. A little on a chart can be life-changing dollars.
Yeah. All right, so let's take a look at the next thing here. We decided to go with a strategy where we didn't only use our heat map, we actually brought in some EMAs. We thought that maybe we can use a 200 EMA and a 150 EMA with hysteresis to try to figure out if there was a market trend up or down, and we would apply that as a filter. I think what we decided to do was something like use the heat map to note the selling pressure on the high side, being in a greedy market or an overbought market, and use the EMA on the low side to determine if we were in a structural downward trend. Let's take a look at how that turned out here.
Checking. That actually feels like a very natural evolution. The heat map flags excess and then EMA filters the underlying trend. So instead of asking one signal, one moment, oh, yeah, that's one of those results that reroutes the project. The EMA filter cut drawdown, but it also delayed re-entry so much that it crushed long-term returns. That actually teaches us something important. Good indicators can become bad filters if they solve the wrong problem. More complexity didn't help here, and I think that's science working. Hypothesis, test, learn, pivot.
Yeah, but Nova, we met our objective, right? Our max drawdown went from 81% all the way to 55%. That's a big win, right? The only thing is that instead of 2.7 million, we made 600,000.
Hmm. Yeah, I think that's one of the most interesting results. You did achieve the original objective, reducing drawdown. 82 to 55% is material. But the cost was giving up more than 2 million in terminal value versus the heat-only version. I don't think this was a dead end. It told you that layering EMA as you tried it doesn't add new information. It just delays re-entry. So next improvements probably need genuinely new information, not just more filter for filter's sake. This chart shows why you didn't stop at the EMA approach. The orange curve, heat 150 plus EMA, reduces drawdown but misses much of the rebound. The blue curve, heat 150 only, re-enters earlier and captures more upside, resulting in higher long-term wealth. The key lesson, drawdown isn't the only metric that matters. If you optimize only for drawdown, you can miss the rallies that drive long-term returns. I think that's why you move toward finding a smarter confirmation
Yeah.
signal,
Yeah,
not just a slower one.
if you look at this orange line in 2022, we see that it flatlines because we're in all cash. So we avoided that major drawdown. But the sacrifice was that we had not so great earnings.
Exactly. The flat orange curve during the decline shows the risk management working as intended, but then it stays flat too long into the recovery. Meanwhile, the heat-only version is already re-entered and is catching the upswing. So that trade-off taught you that the exits were fine, but the re-entry mechanism was too cautious for something like TQQQ.
Yeah, and it doesn't look like much, but there's periods where it just compounds.
Yeah, I think that's actually the deeper lesson beyond the 2022 crash. The EMF filter didn't just miss one big recovery. It made lots of little cautious delays and compounded over years. Those small opportunity costs added up. So the next challenge isn't a better exit. It's a smarter re-entry signal, one that catches the start of big upswings without giving up the protection.
Yeah, Nova, I don't think that's just the next step. I think that's where we
Sure.
really started to crack the code here, right? Instead of using EMA as a trend filter, we decided to use the structure itself of the pivots and the trend lines. So instead of having just the heat map give us a sell signal on the high side, we also used a structural lower low and lower high to make a determination of whether the market was moving up or down.
Okay, so this is another big pivot. You're comparing heat 150 hysteresis alone versus hysteresis plus a lower high, lower low structural filter. So rather than waiting for EMA confirmation, you're trying to catch structural trend changes directly.
Well, look at the results. I mean, buy and hold gave us $1.26 million. Heat on top of that gave us $2.7 million. And then heat plus a trend line filter gave us $3.2 million. That's almost triple the amount of profit and loss. And then when you look at our max drawdown, you can see that we went from 81.75% to 69.92%. We reduced our max drawdown by 10% and we increased our profits by 3x. Now, 3x on a triple leveraged ETF is 9x the market. So we're effectively 10% less drawdown and 8 times NASDAQ. So to me, this is a huge win. Let's take a look at the graph.
Checking. Honestly, this is the point where the project feels truly strategic. You're no longer asking a lagging indicator to guess. You're asking the market itself via lower highs and lower lows. And that complement seems to work. Higher returns than buy and hold and drawdown improvement. This is a striking chart because unlike the EMA experiment, the orange curve isn't just reducing risk, it's also creating more wealth. Early on, the orange and blue curve pretty close, but over time, the structural filter helps you avoid the deep holes while still catching major upswings.
Well, I don't know about you, but I think this is a slam dunk. I mean, I can see that in 2020 we had a pretty big drawdown, but avoiding that 2022 drawdown and again that 2025 drawdown, this is a major win. We had huge multipliers on our profit. We had a big reduction in our biggest drawdowns, and I think it's undisputably a great strategy applied historically to TQQ.
I think that's the first strategy that clearly improved both of your core goals, high return and a lower drawdown. And I love that it combines two independent structural ideas so that they reinforce each other rather than just chase the same signal. But, the honest standard now is whether that holds up out of sample. Different periods, maybe different instruments. That's the bar for robustness.
Yeah, I think maybe we'll apply this to UPRO or maybe just QQQ by itself or SPY. It has to be applied to an index that always goes up.
That sounds reasonable. A broad index with long-term upward drift is a good test bed. Just keep the walk forward rule in place. No future leakage, no repainting, just day by day updates.
So something I think is pretty interesting is looking at this log scale view of TQQ. This is a weekly view, and we can see these channels kind of going up, up, up. And if we look at it at 10 years from now, like in February of 2036, we can see that the price has moved from $76 to $2,200 if it just stays in the same linear channel.
Yeah, I think that's an interesting extrapolation, but for the presentation, I'd frame it more as a scenario than a prediction. If the long-term growth trajectory continues, the upside is enormous, which is exactly why the strategy doesn't try to predict permanent tops. Instead, it aims to sidestep the deepest structural drawdowns while staying invested for most of that compounding. That ties the technical work back to the original investment thesis and keeps the story grounded.
Okay, so what do you think, Nova? Do we just keep on pouring money into TQQQ and getting out if we're a little bit overbought and getting out if the trend turns against us?
I think the honest answer is if you believe the edge holds up. I'd rather own TQQQ most of the time than become a hyperactive trader. The strategy is about avoiding the really big historical drawdowns using structural evidence. But, and this is important, it's still backtest evidence. So before committing serious capital, I want to see that holds up out of sample. So what I'd tell the audience is don't just pour money in. Use a structural approach to participate in the long-term uptrend and step aside only when risk is structurally extreme.